In this video, we are going to have a look at relevant costs and how this affects the decision-making process. So first of all, we will have a look at what the definition of both relevant costs and relevant revenues can be defined as. So essentially, these are the costs and revenues which are appropriate to specific management decisions. They are represented by future cash flows whose magnitude is going to vary dependent upon the outcome of any management decision which is made. So some of the features of relevant costs and of relevant revenues include the future of costs and revenues. They can either be incremental or differential. They are also going to be classed as cash flows. What are opportunity costs? Well, these are the value of the benefit sacrifice when one course of action is taken. This is in preference to an alternative. The opportunity cost will be represented by the foregone potential benefit in the best course of action being rejected. It will emphasise that decision-making will be concerned with alternatives and that a cost of taking one decision is the profit or contribution which is foregone from taking the next best alternative. Consideration must be given to profit or contribution if resources are scarce. Cash flows of a single department must not be looked at in isolation either. The next type of cost we have then are avoidable costs. So these are specific costs to an activity or particular sector of a business which can be avoided if that sector or activity did not exist. So for example, if a decision did not go ahead, that cost would not be incurred and therefore it is avoidable by the business. Non-relevant costs then. There are a series of these which you need to be aware of. So the first one is known as sunk costs. So these are irrecoverable. They've already been incurred. We cannot change the past. It could be a committed cost. So these are costs which are going to be incurred in the future as a result of a past decision made. It cannot be changed. It could be fixed costs. So these are absorbed, charged, allocated and apportioned, and ultimately they are just to be ignored. The next one is depreciation. So this is just simply an accounting adjustment. It does not result in any cash flows at all. And the last one then is notional costs. So these are costs which are not going to result in any outflow of cash, neither now nor in the future. Incremental revenue then. So matching incremental costs against the incremental revenues will produce a figure for the incremental gain or loss between the alternatives. So relevant cost of material. So if materials are not already held in inventory, the relevant cost is going to be the cost of the purchase. How much is it actually going to cost you to buy that material? If material is already in our inventory and they need to be replaced, the relevant cost is going to be the replacement cost. If materials are already in inventory but are not going to be replaced, it must be considered whether the materials are going to be used for other purposes. If the materials are going to be used for something else, the relevant cost is going to be the opportunity cost for using it in an alternative way. If the relevant cost is not going to be there, it essentially means that that material is not going to be replaced, nor is it going to be used. The relevant cost is therefore going to be equal to the net realizable value. Relevant cost of labour then. Well, if you have spare capacity, it means that your existing workforce are idle and they are being paid regardless. It is going to be at no relevant cost to the business. If you haven't got any spare capacity, then the only option is going to be to hire some additional workers. Your relevant cost in this scenario is going to be the cost of hire to the workers. If you have no spare capacity and your only option is to transfer existing workers from an alternative project, perhaps you are changing their position on the production line, your opportunity costs are going to be your relevant costs. And if you have no spare capacity with a choice of hiring in to transferring labour, your relevant cost is going to be the lowest of the two costs there. Relevant cost of overheads then. Well, only those costs that vary as a direct result of a decision taken can be classed as a relevant cost when looking at overheads. Relevant costs of non-current assets. So if the asset is going to be replaced, the relevant cost is going to be the cost of the replacement. If the asset won't be replaced, it's not going to be sold, your relevant cost is going to be the net cash flow from the use of the asset. And if that asset won't be replaced, but it is going to be sold, the relevant cost is going to be the net realizable value. So we've had a look at some non-relevant costs, and we've also had a look at how we deal with relevant costs. But how are these linked to decision making? So limiting factor decisions then is something that we need to consider. So just to remind you, a limiting factor is a resource which is scarce and thus prevents an organisation from actually achieving their desired output levels. Where there is a limiting factor, it is extremely important that a business prioritises products with the highest contribution. So a single limiting factor technique can be used to work this out. In that scenario, you would first identify the limiting factor. You would then calculate the contribution per unit for each product, and then you would calculate the contribution per unit for the limiting factor for each product. Then you would rank the products in order for the highest contribution per limiting factor. And the final step then would be to allocate the resources that you have to the products using the ranking system that you have put in place. We then have make or buy decisions. So this is about making the decision of whether to make a product in-house or whether it should be bought in externally. So products should be ranked from highest to lowest based on the saving made per usage of the scarce resources. So what are the steps then if we consider a make or buy decision? Well, first of all, we need to calculate the saving per unit of each product. So in order to do this, we take our purchase price less our variable cost to make. We then divide that amount by our scarce resource and how much each product actually uses. So this will give us our saving per limiting factor. At that point, we then need to rank our decisions, and the higher the saving per unit, the greater the priority of making or investing in that product. Once the priorities by the business have been decided, the scarce resource will be allocated to the products until they are fully absorbed. And the final step for this is to ensure that any products that have unsatisfied demand can be satisfied by buying from an external source. So there are a few things then that you need to consider and a business should consider when they are thinking about buying in instead of making internally. So what is the reliability of external suppliers going to be like? Perhaps they can't be as reliable as you, perhaps they can't produce as many products at such a quick pace. Specialist skills. Will an outsourced business supplying you goods have the same high quality skill level as your employees to be able to produce the same high quality products? It could be an alternative use of resources. So have they got some better equipment perhaps, or is their equipment not as good as ours? What's the impact on staff going to be? If they find out that you are outsourcing work, they may well find it as a demotivator, that you may have a drop in morale, which could lead to a loss in productivity in your normal day-to-day role of your labour force. And also customer reactions. The most important thing in a business is your customers. Without them, you wouldn't have a business. So is the customer going to be okay if you are buying things in instead of making it yourselves? Are they going to get that same high level of quality that they have received in the past? Discontinuation decisions then also need to be made sometimes. So it works to discontinue a segment of the business, a product or a service or whatever it may be, is going to happen if it becomes unprofitable. However, before making that decision, you as a business would investigate as to why it's become unprofitable. Can certain costs, can certain revenues become avoidable? Is the business going to flourish without them still? We then move on to quantifiable costs or benefits of discontinuation. These are not limited to, but can include lost contribution from the area that is being closed. So a business needs to evaluate which business venues, which business locations are bringing in the most contribution and close the ones with the lowest. It could be savings in specific fixed costs from closures. So if you are closing down a shop or whatever factory, you are obviously going to save on heat, light, rent, mortgage, etc. Penalties and other costs resulting from closure then. So is there going to be any fines payable? Is there going to be any issues that are going to arise as doing this? You may also need to consider any reorganization costs. So things like, if you are going to keep your workforce on, you are going to have to pop them into different locations perhaps, and you're going to have to make it work for both the business as well as the staff themselves. Any additional contribution from the alternative use of resources must also be released. So prior to buying in then, instead of producing, we've talked about some of the financial considerations, but there is also non-financial considerations which we need to think about. So first of all, we kind of touched on it a little bit. It is our impact on our staff. Are our staff going to be okay with it? Perhaps it is going to act as a demotivator. They maybe don't feel as though they're good enough to do this particular project, which is why we've outsourced it, which could lead to low productivity. Worst of all, it could lead to staff leaving. Another one that we touched on a little bit was our customer reactions. So are customers going to be happy if we all of a sudden start outsourcing work? Are the products that the customers are going to be buying the same high level quality that we were producing in-house? It could also affect the wider community. So if we think about the local economies, essentially businesses should be helping those out. If we outsource work, who's to say we're going to do it within the same area? And it's also the company reputation. So if there is a drop in quality, customers buy a product, they're perhaps not as happy as what they once were, they're going to go elsewhere. So we've gained a poor reputation whilst we've also lost customers. So sometimes a business will make special selling price decisions. So if the selling price of a contract is already known and it is going to be greater than relevant costs, the order should be accepted. If, however, the selling price is unknown The minimum price should be set at the incremental cost of manufacturing plus any opportunity costs. So we then have to go through some further processing decisions. So with this in mind, we need to decide whether further processing is worthwhile when we look at joint products. Should the whole process be carried out is the first question a business should ask themselves. They need to be able to consider the total revenues as well as the total processing costs. On the back of that, they need to then consider, should we further process products? So we do this by considering the incremental costs and the incremental revenues. Conflict with financial accounting then. So this is kind of a cash versus profit scenario. So why is cash flow and profit different? Well, essentially they are two different things. So capital receipts and capital payments do not affect profits because essentially they affect our statement of financial position as opposed to the profit or loss statement. So a business who earns a lot of profit but has a lot of capital expenditure is going to have a negative cash flow. There's no doubt about that. Another reason is depreciation is a non-cash item, but profit is going to be calculated after the deductions have been made for it. Thus, it is not going to impact cash flow, but it is going to decrease our overall profit. And cash flow is affected by the need to invest in operational working capital. At the point in which the working capital amount changes, profits earned in a period are going to differ from that of operational cash flows. So one of the big things then around the accounting world at the moment is all about acting ethically. That's never going to change. But we need to think about how can a business act ethically whilst making the right decisions, whilst thinking in the short term. So why would a business want to behave ethically? Why should they behave ethically? There's all sorts of reasons why. So first of all, it makes the business more attractive to stakeholders. They want to be a part of a business that does well for society, takes into account the wider community. It allows financial penalties to be avoided. It means that less investigations are going to be taking place by regulatory bodies. It could indeed create more stable earnings because the business is acting in such an ethical way that it's unlikely that it is going to be closed down by those regulatory bodies. Everybody's happy. Obviously, there's many benefits to acting ethically, but some businesses will also see it as a drawback. And again, there's reasons for and against this. So what are the problems with it? Well, success is often going to rely on a trial and error approach. So if we act globally, there's going to be a lack of consistency of ethical standards. So, for example, here in the UK, we have the national minimum wage. A business has to pay an employer at least that amount per hour. If we open overseas, or if we open up a factory, production line, there may be no such thing as a national minimum wage. We can essentially pay the workers what we want, and we see that time and time again in these bigger countries. It adds costs to the business without a doubt, because if we want to act ethically, we have to do it to a very high standard. We need to do it properly. The strategy can easily be copied, so it's unlikely to gain a competitive advantage. So just because I'm acting ethically doesn't mean that my competitors aren't going to either. So that is it in terms of our relevant costs, our non-relevant costs, and how to act ethically within the workplace and the benefits and drawbacks of doing so.